Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me typically would be the governor, Mr. Michael Becker, but he is on another due diligence assignment, which is really he's taking a second part of his holiday vacation. So we wish Michael the best of the due diligence of a holiday vacation. So it's a brand new year. Happy New Year to you and to your family. From the economists that I speak with, the brokers that sell apartments, and the apartment owners that we finance apartments for, 2019 is going to be another good year in multifamily. So we're very excited. I also want to mention that Old Capital closed over $1 billion in apartment loans. So we could not have done that without you. So thank you very, very much. We appreciate all the kind words you leave in the emails and on iTunes. So please leave us a 5-star rating if you think we do a good job in educating you about apartments. So thank you very much. So we have JC Castillo with the Multifamily Property Group sitting in the podcast today. Welcome, JC Castillo.
Hey, Paulie. Thanks for having me.
JC lives in San Jose and invests in apartments in Texas, and you have heard him several times on the podcast. JC, Brad Sumrock, and I sponsor the Northern California meetup that focuses on apartment investing. And that's in San Mateo, California. And on January the 16th, we have another opportunity to learn more about apartment investing. JC, can you explain the agenda for January 16th and how do folks sign up?
Yeah, sure, Paul. So really the thinking behind this meeting coming up is that we're calling it apartment in a box. And so what we want to do is especially for those new investors out there that want to learn about multifamily, we're going to take them all the way from underwriting and acquiring a deal, how to find deals. We're going to show you how to actually acquire a deal, how to finance a deal. And on the back end, we're going to show you how to reposition it and talk a little bit about what it takes to actually operate a deal. So we'll cover all that information at this meeting. So if you're new to multifamily and you're looking to figure out how things work, this would be the perfect opportunity to come in and get a crash course on how it's done.
So that's up at the Marriott in San Mateo, California on January the 16th. JC, what's the best idea? How do people get invited or RSVP to that event?
Absolutely. So the best way to get a hold of us is to go to our Facebook page. You can do a search and just look for Apartment Investor Network. Apartment Investor Network on Facebook. You'll find our Facebook page, and we'll have an event calendar item, and you can sign up for it, and you can come out and see us in San Mateo on January 16th.
This is one of the premier events that JC, Brad, and myself do up in Northern California. We have a lot of people that attend that meeting. It's a great networking event, but the education about what's going on in the market, I think, is superior. I also wanted to mention that on Wednesday, February 6th, so we have another Old Capital speaker series in Dallas at the Grapevine Convention Center. Make sure you put that down on your calendar. So if you're new to apartments and you really want to be at this event, so we're having a fireside chat with Freddie Mac and one of their top apartment economists. So we'll be talking about how new apartment buyers can qualify for their first deal. So how new apartment buyers can qualify for their first deal. So we have one of the head people of Freddie Mac Small Balance. So she's responsible for every transaction west of the Mississippi River. So you want to listen to her insight and how it will help you win a deal in 2019. So we should have over 250 to 300 folks, and it'll be a great opportunity to network. So see you there. So remember, you want to sign up on both those events on the oldcapitalpodcast.com. Go to the Old Capital Podcast to sign up for those events. So hopefully we'll see you in Grapevine, Texas on February the 6th. Today, we have a kind of a new segment on the Old Capital Podcast. I'm going to call it Ask the Underwriter. Ask the Underwriter. So Ask the Underwriter really is ask the loan decision maker. So they're the folks that approve your apartment loan. So you have questions, we have answers. We're going to feature a different underwriter once a quarter. Every lender has different rules. So we're going to have the Fannie Mae underwriters, the Freddie Mac underwriters, the Freddie Mac small balance underwriters, FHA underwriters, bank underwriters, bridge underwriters. So we're going to feature a different underwriter every quarter, the decision maker. We want to focus on having you understand what's going on. I want to point out that not all apartment lenders are the same. One may like this, one may not like that. So you need to understand what's important to them, how to qualify, and how to structure your transaction. Remember, your lender in certain cases can bring up to 80% of the money to the deal. So understanding some of the basic rules in commercial lending can save you time and stress in putting your deal together. So today, we have two Fannie Mae underwriters. These are the decision makers from Doherty Mortgage. Doherty is a Fannie Mae DUS lender. DUS lender. Yeah, they are one of the 25 lenders licensed through Fannie Mae. We will explain what DUS means in a second. And through our partnership, Old Capital and Doherty has closed over $1 billion in Fannie Mae apartment loans. $1 billion with Doherty. So today we have John Banyard and Fritz Waldvogel from Doherty Mortgage. They are the decision makers. So John and Fritz, welcome to the Old Capital Podcast.
Thanks for having us, Paul.
No problem.
Thank you, Paul.
So, John, tell me a little bit about your background. You're the senior person here. Let's talk a little bit about what's your background and how long have you been at Doherty?
Sure, Paul. I started at Doherty 11 years ago in 2007, and prior to that, I worked for another DUS lender for 6 years. And before that was a banking background.
And what do you do for Doherty?
I'm their chief credit officer as well as their Fannie Mae chief underwriter. Doherty also does HUD lending, so we have other HUD chief underwriters and the like.
So as we say, you're the man.
I suppose.
For sure.
And Fritz, tell me a little bit about your background and what do you do for Doherty?
So I'm on the production team. I started at Doherty basically right out of school 6 years ago. I went to school at University of St. Thomas in the Twin Cities, and then afterward actually went and lived in Europe for a year and played American football, and then came back and got hooked up with Doherty, and I've kind of been there ever since. I started actually working for John in the credit department, and I did that for about a year and a half, 2 years, and then moved over to the production team.
So going back to John here, tell me a little bit about Doherty and what does your group do?
Sure, Paul. So Doherty is a mortgage company that was started in 2006 that is part of a Doherty Financial Group, which started in investment banking over 41 years ago. So in being with the mortgage company, we started with a HUD and a Fannie Mae license in 2006. And what we do is on the underwriting side is folks like Fritz bring the credit people and the underwriters the deals to underwrite.
So you guys originate and service billions and billions of apartment loans throughout the United States. So tell me a little bit about what does DUS, D-U-S, what does that stand for and what does delegated mean?
Of course. DUS stands for Delegated Underwriting and Servicing. And there are 25 lenders in the United States that have DUS licenses. And Doherty is fortunate enough to have one of those licenses. What that allows Doherty to do is to originate, underwrite, close, and service loans that are underwritten into a prescribed set of criteria. And each of those 25 DUS lenders is allowed to originate those loans. And in cases where if there's a variance in a structure or a term, we call those waivers. And that is the only time we really have to go to Fannie Mae to consult with them or get approval for something like that.
You're in a fortunate position with having a DUS license is that you have the ability to originate these loans, but also underwrite these loans based on Fannie Mae's criteria. You don't really, unless there's a waiver that's needed, you don't have to share your underwriting with Fannie Mae to make a decision. And that's different from Freddie Mac. And can you explain what that difference is, Fritz?
Sure. On a Freddie Mac transaction or a FHA HUD transaction, we would underwrite the deal how we believe it's correctly underwritten into the rules. However, the ultimate decision maker would be Freddie Mac or FHA. So on the Fannie side, as John just mentioned and Paul, we have the ability to underwrite these deals ourselves. And if we feel comfortable with the underwriting and it fits in the box, we can originate it and service it.
And probably the bigger benefit is that because you guys are really the decision makers in the transactions, you can give faster answers than what say probably Freddie Mac can probably do because You don't have to package it all up, submit it to Freddie Mac for Freddie Mac to underwrite the deal themselves and get the decision back. So you're able to underwrite these deals up front. Is that true?
Yes. Yeah. So we're able to underwrite all these transactions up front to how we deem is appropriate for each transaction.
So Fritz, let's talk a little bit about Fannie Mae underwriting, because that's what we're here for. I want to find out a little bit about what you guys do, how you guys make these decisions to fund these transactions. Unfortunately, I have so many questions and not enough time, so we may have to break this up into two sections. But why should a borrower use Fannie Mae to finance an apartment, and what are the benefits to doing a Fannie Mae loan?
I think one of the major benefits for an investing group is all these loans are non-recourse. Now they have bad boy carve-outs for fraud and such, but you're able to get a non-recourse loan and get some of that personal guarantee off your balance sheet. Fannie Mae also offers competitive terms. So generally, general acquisition terms are usually fixed. They do offer variable rate terms as well, 30-year amortization, and can also get some interest only on acquisitions. So it's a very competitive loan platform. All the loans are assumable with Fannie Mae, and they also offer supplemental loans or second liens. So you're able to, in year 3 or 4, borrow up and get some of your investor equity out if it's justified.
Yeah, a lot of people know Fannie Mae as being a home loan group through the government, but Fannie Mae and Freddie Mac do a majority of the financing of apartments. And because they kind of have the full faith and backing of the United States government, they're able to get these pricing of these loans of just apartments down. So it's definitely a benefit to develop a relationship with a Fannie Mae lender just like Dougherty. So at what loan size and unit size does Fannie Mae start?
I would say about a $1 million mark is kind of the benchmark. They'll probably go a little bit lower than that, but for the most part, it's $1 million and upward. There's really not a cap on loan size. They'll go up to $1 billion on a deal as long as it pencils.
So then, John, what is not a Fannie Mae loan? Why should a borrower not do a loan with Fannie Mae?
Typically, Fannie Mae's strength has been in permanent long-term financing. So if a property has not completed construction or it hasn't been built yet, it's really has typically not been the best venue for brand new construction. Now, Fannie is working on products right now. They have a forward program, but that's generally dedicated towards affordable housing type property. So transactions in which the rents are affordable and have some sort of regulatory agreement.
Fritz, anything more about that? What does not make a Freddie Mac loan or Fannie Mae loan?
Obviously, like John mentioned, I would say, properties that are not well occupied, generally Fannie wants to see 90% physical occupancy generally. They can go down to 85% physical occupancy and no more than 75% economic occupancy. I would also say, you have to look at what are your goals? So, Fannie Mae's biggest strength is probably long-term financing. So these loans have yield maintenance or step-down prepays generally on the fixed rate loan. So if this is a property you want to come in and put a bunch of money into and then sell in 12 to 18 months, the Fannie Mae platform may not be the best. Now they have another couple you could structure it as, say, a variable rate transaction with a little bit easier prepayment penalty. But generally, these are loans that you want to hold for at least 3 to 5 years.
So let's talk about qualifying for apartment loans through Fannie Mae. So what's Fannie looking for net worth, liquidity, and experience?
So Fannie generally does not want to get you into the apartment business. They want to make sure you have some apartment owning experience. From a financial situation, they want net worth equal to the loan amount and at least 10% liquid. And that can be, combined between whoever partners in the deal are signing the non-recourse guarantee. So if you have 3 people signing, call it on a $10 million loan, between those 3 partners, you need to have a $10 million net worth and $1 million liquid.
Okay. So can we do rehab dollars into the loan? Is that possible to put some rehab dollars in, John?
Yes. Fannie Mae has several programs that allow for that. They have a moderate rehab program, which allows you to do improvements up to, say, $10,000 per unit.
Yeah. How does that come in handy for Fannie Mae, Fritz?
So it allows you to, you build that up in your loan to cost. So in today's environment, it's a little harder to roll in all those dollars just because of where cap rates are in certain markets and where interest rates are. But ideally, you can lend. So say it's a $10 million loan, you're doing $2 million rehab. We can lend up to 80% of that $12 million number, not the 10. Now we would have to escrow for those funds with the lender at closing, but it allows you to get a little bit more leverage. And generally, Fannie will be more aggressive in terms we feel more comfortable as the DUS lender if we know that money's going into the asset. If we're escrowing for the funds, then you're going to be doing some sort of improvements.
Yeah, one of the things we mentioned right from the beginning is that Fannie Mae is a stabilized lender. They're not a lender that's going to be a bridge lender typically. They're looking for cash flow. Just like, they want to make sure that they can see historical numbers for the last year and a half or so of cash flow numbers. And they want to make sure that that cash flow is going to continue on through not only you buying the property or the person selling the property, but you buying the property and make sure it works. So how do you define a property as stabilized? What does that mean? What's physical occupancy and what's economic occupancy? You mentioned it before. I want to make sure I understand it.
Per Fannie's guidance, they consider a stabilized property if it has 85% physically occupied over the last 3 months and 75% economic occupancy. Now, we would probably prefer to see occupancy higher than physical occupancy of 90%. When we're looking at deals, you just feel a little bit more comfortable there, but the technical Fannie rules are 85% physical and 75% economic, and that difference is physical occupancy is how much of the apartment's actually filled, and then economic occupancy is what they're actually collecting. So if there's concessions, bad debt, they're not actually paying rent, are the two major ones that we see.
As I like to say, it's easy to fill these properties up, put bodies in the beds or so. It's tough to actually get them to pay. And that's what the difference is between physical and economics. You can put the bodies in, but you want to make sure everyone's paying at some period of time. So one of the things that you mentioned also too that I picked up is Fannie Mae good for new investors? And if you're a new investor and you don't have multifamily experience, how do you structure deals that help you underwrite these transactions?
What's fairly common is you would partner with someone that does have the experience. So you've got to find someone that may have done some Fannie loans or has some apartment owning experience that could get the DUS lender comfortable with moving forward with you, even though it's your first deal. It's common that you can borrow the experience of somebody else that you partner with.
That's great. John, when you guys are underwriting these transactions on the front side of the deal, you see an opportunity to make a loan and you push out a term sheet. What do you need from the potential buyer to get a term sheet produced? What are you looking for?
We're looking for, first, we have to complete a loan sizing. So we're looking for the financial information in order to complete such a sizing, including a rent roll, as you also indicated, several years of operating statements, as well as a resume in terms of, just something to elaborate on the borrower's experience. And then we look at that and what the actual loan request is. And we look at the market, the submarket, and we look at the attributes of that market. How is that market doing? How are the industries? How is employment? And we go through all of that as part of doing the sizing. And then based on that, we're able to come up with a term sheet in terms of getting the loan sized.
So why can, Fritz, term sheets be different between two Fannie Mae lenders, and what should the borrower be looking for?
It just depends on how each group is underwriting it and what you're assuming. I think, in a lot of these acquisition transactions, you're looking at, pretty much across the board, you're going to look at in-place income and then, a lot of times budgeted expenses on an acquisition. So, another thing I would add on to what John just said is if you have a pro forma, like your year one operating expenses that you expect. A lot of times, some of these properties, they may have really high payroll or, they have CapEx built into their R&M, repair and maintenance expenses. So we can take a look at what you think you can operate the property. And so long as it's in line with an appraisal, we can conclude to those expenses. So it can really vary depending on what expense information that they're assuming. In Texas, the real hot button item is taxes. So in the state of Texas, you got to take a look at, after you acquire that asset, how is that going to affect your real estate tax numbers? So that could be, 60, 70, 80, 90%, 100% in some cases, times the millage rate for that county. So you really got to dial in on the real estate taxes, because in today's environment where everything's debt service constrained, if you miss on your a real estate tax number a little bit, it can have a significant impact on your
I would say that one of the things that if you're comparing term sheets with other term sheets is that one borrower is not the same as another borrower, for one. So you may get a more aggressive term sheet that may not have gone to you or should not have gone to you, but it was probably may have gone to somebody that had Instead of just having a brand new one apartment building, it could have gone to somebody that had 10 buildings. So don't confuse one term sheet with another term sheet. The second piece is what you should look for, not just what the loan amount is, but look how they got to their expenses and how they got to their income. So make sure when you get a term sheet, go down and understand on what expenses are per unit and how they calculated their property taxes. So term sheets can be different because of the interpretation of what that analyst for Fannie Mae believes what the expenses can be. So what we're really looking for your input is how can you manage this property that makes sense without really cutting or starving the property by cutting expenses too far back. Anything more to add to that?
No, I think you're right on it. And each borrower is going to be deemed differently. For example, if you have a good track record with Fannie Mae and they know that, and, say you've been through a couple cycles with them as a borrower and you've always made your payments, you've always, maintained a good asset throughout the servicing process, they're going to feel more comfortable and probably be more aggressive on some credit terms than some that they don't have any experience with.
And I would say one of the big differences and one of the things that I do like about Doherty is that if you get issued a term sheet and it's acceptable for you to buy this property and they do issue an application to you, they do something a little bit different is that they'll go around and they'll go to pre-committee first, where all the decision makers has seen your financial statement, has done some analysis on the property itself, making sure everything makes sense before you get engaged. Because the same people who are seeing it up front are the people who are going to see it on the backside. How different is that versus a lot of the other dust lenders out there? It's an anomaly. Would you agree?
Yeah, we're one of the only one I know of that goes through that process. So our team meets every Thursday morning to go through any new deals that are coming in, and our team will put together a full package of the underwriting, who the sponsor is, location, photos. So we present to our decision makers, John being one of those. They've seen the deal on the front end. So for some example, someone on credit committee doesn't like this location, feels concerned about it. That before you issue your term sheet and say you can do something, that same issue is going to pop up 30, 40 days down the road. So It's better to know that on the front end.
No, it's a big deal. John, anything more to add to that? Because you run that committee.
No, of course. We're giving guidelines here, but I'd like to add that there may be, like Fritz said, we'll use location as an example. If one of the committee members may not be great with that location, well, what we'll do is we'll reach out to Fannie Mae and find out perhaps. If we don't have a whole lot of business in that particular market, we'll reach out to Fannie Mae for some guidance and find out what their experience has been there. So what also makes our process unique is between doing that extra legwork up front, we're looking to build relationships. And it's a two-way street. The lender has to also, it's easy for a lender to say, yes, well, the borrower has to have a relationship with us. Well, we have to also have a relationship with that borrower. And by doing this, what we're doing is we're making sure as much as we can before all the due diligence is completed, the third-party reports, the extra studies, that within reason, we have a very good feeling about being able to perform in this particular case.
It absolutely makes sense, especially in this competitive environment where they're asking you to put hard money down. You want to have a lender that stands behind you that's already seen the transaction up front. It's not just the analyst has done the deal, pushed out an application to sign. You want to make sure that the credit committee has already seen the deal. That is the unique piece that Doherty brings to the transaction. John, let's talk a little bit about leverage. What kind of leverage can you expect these days, and how is leverage determined?
Certainly. It's typically based on their perceived risk of the product type. For instance, seniors housing will have a lower leverage point because you have an inherently more risky product type. Risky meaning you have all the attributes of an apartment building, but then you're adding a food and beverage component as well as a medical component. So you actually are having two businesses. In addition to the real estate, as I would call the food one component, and then of course the medication and caregiving a third. So those leverages are going to be slightly lower, typically about 5 percentage points for acquisition and for refinancing. So typically it would be 75% for a seniors housing versus 80% then for conventional or market rate.
So anything more to add to that, Fritz, at all?
No. So, in today's environment, those are the parameters. You can go up to 80% on an acquisition, 75% on a cash out refinance. But in today's environment, based on the coverage and I'm sure we'll get into that in a little bit. It's just really hard to get to full 80 in certain markets where cap rates are and where interest rates are at today.
Talk a little bit about what pre-review means. Some people hear that it lowers your maximum leverage down a little bit pre-review. If we were doing a transaction in Houston or in some of these pre-review markets, what can we expect for leverage?
Yeah, so whenever Fannie has a list of a lot of markets across the country, and there's a lot of different reasons that they may be on that pre-review list, but they do not allow the DUS lenders to have the ability to lend on those assets without talking to Fannie first. And so generally in those markets, they're not going to be as aggressive. So you can expect closer to 65% leverage in those type of markets. And in some pre-review markets, they may not be willing to really lend at all, depending on sometimes it's exposure. Like I know in Texas, there's a few markets here that they own they lend on too much of the total apartment stock, and so they really don't want to add any more to that just from where their exposure is. So they'll really look at the deal if they already have the debt on it, but they really don't want to add any more loans.
Let's kind of walk through a couple places in Texas so people can put their heads around it. So Dallas and Fort Worth, you could go up to 80% leverage.
Correct.
San Antonio, you could go up to 80% leverage.
Yes.
Austin, up to 80% leverage.
Yep.
Houston
is on the pre-review list. I would say no more than 75% in that market, depending on the deal. Houston's a little bit of a finicky market. It's got a lot of oil and gas exposure.
Yeah, there's two things.
Yeah,
just like when you mentioned, there's just too many apartment loans that Fannie Mae did, so they have exposure just to the product type. And then two, we have too much exposure in Texas to oil and gas, especially in Houston. So if oil and gas is at 110, it's not a problem. If it goes down to 40, it could be an issue. Having too much exposure, so they don't want to be at max leverage. Correct. Let's talk about some of these smaller towns like Midland, Odessa, or even out in Lubbock as an example.
Yeah, so Midland, Odessa, similar. They have too much exposure, and they have the oil and gas risk there as well. Another one is Tyler, Texas, is on that list, just east of Dallas, and they just have way too much exposure. And usually, what Fannie considers too much exposure is say 40% of the total market share in that submarket.
So, John, can you take us through a little bit on a typical purchase transaction? So, you guys, somebody wants the loan, you get them to an application. What happens next behind the curtain? What happens in Doherty behind the curtain?
So, typically, when we take an application, we'll get a deposit to order third-party reports, which would include an appraisal, a environmental study, as well as an engineering study. And those three reports are prepared. They typically take anywhere from 2 to 4 weeks. You can have them expedited for a slightly increased cost to get those done in 2 weeks. And what that does is that's helping us evaluate the actual asset itself physically, as well as to find out environmentally what's happened. But on the appraisal side, we're also checking the market to find out how has the market performed. How are the rents at the property compared to other similar properties in the market? And then in addition to that, Doherty would prepare a checklist for a borrower to put together other pieces of information. And usually that checklist process goes on while the third-party reports are being done, so that usually by the time the third-party reports have been completed, the lenders hopefully also inspected the property, and they've gotten their checklist together, and then they get into the analysis required for preparing a recommendation for a loan committee. And simultaneously, when you get to about that point, then you get the legal process started, so that as you're going to loan committee, you're also ramping up. The borrower is ramping up to get their counsel, and the lender is also getting their counsel involved in the property, and hence you're working on title work and surveys and some of the more nitty-gritty legal items.
What's the timing that it takes for somebody that's just about to get into a purchase sale agreement? What's the timing from the period of time that you take the application and pushed over the funds for the deposits for the third parties, the time you actually close? How long does that usually take?
Generally, I would say 60 days from start to finish conservatively. It can go quicker depending on if you're able to get your documentation in faster. So I would say anywhere from 45 to 60 days.
Yeah, as the lender, you have to actually physically visit every property that you make a loan on. So regardless if it's up in North Dakota, South Dakota, North Carolina, South Carolina, you have to physically look at the property, walk some of the units, and you're the eyes and ears for Fannie Mae on these transactions. what should borrowers know about the Fannie Mae Green Program in 2019? Why don't you talk a little bit more about what the Green Program is and what we can expect?
Sure. So Fannie really started pushing the Green Program really in 2016, end of 2016. And it's Fannie's way of, giving you a discount on your interest rate for doing some sort of green repairs. Originally, it was you needed to create 20% savings either through water or energy savings. And if you do that, and we escrow and you complete it within 12 months, at the start, they'll give you a lower interest rate that could be anywhere from 20 basis points to 40 basis points, depending on size and leverage. Moving into 2018 and 2019, Fannie's now pivoted, and now it's requiring 30% savings to get that requirement to meet the Green Program parameters. And of that 30%, half of the savings has to come from energy. In 16 and 17, we were seeing a lot of times you just had to replace, aerators, shower heads, and maybe toilets to hit the savings parameters, which was fairly inexpensive comparatively where your interest rate reduction would go. Now as we move into 2019, I think it'll be a little bit more difficult to hit that target. I'm not saying it can't be done depending on the property type and what's actually been completed, but it could be a little more difficult to hit. We've also noticed really in the last 4 to 5 months, the pricing differential between not doing the Green Program and doing the Green Program. Instead of it used to being 20 to 40 basis points difference. In some cases it's none. In some cases it's only 10 or 15 basis points. And if it's really a lot of work that you got to complete to hit the Green Program parameters, you got to look at that cost benefit analysis and see if that really makes sense. Where in 2016, most of the time, 2016, 2017, it made sense.
My 2 cents right now is the Green Program is really the red program. It's going to put you into the red if you actually do it. Because it's going to cost you a lot of money to do these repairs in the properties. And it used to be that you could take a 3.2 gallon toilet and then convert it into like 1.7. Now the toilets are going to about 0.8. Mm-hmm. I mean, the flush capacity that continues to go down. So, you can't get water savings that much if you keep on going farther and farther down. It just doesn't make sense. And the financial reward from Fannie Mae that had encouraged people to do it doesn't make sense. So we're not pounding the table on the Green Program, and so don't consider that. You can consider it, but look at the cost benefits analysis on that deal. John and I go around and around on interest only. I hate interest only. John knows that, which means that when you do interest only, you're not paying principal during the portion of the term of the loan. Lots of investors use interest only to tweak the rates of return on the cash-on-cash returns for their investors. But John, how can I get 10 years of interest only?
So for 10 years of interest only, you're likely going to have to put down upwards of 40 to 45% of equity up front.
But you can do interest only for 10 years.
Yeah.
You can
Certainly.
get a full term of interest only. But there's a couple different levers on this. If you want interest only, you're going to have to put some significant cash into the deal. Mm-hmm. If you want to do maybe 5 or 6 years of interest only, you're not putting down maybe 45%, but maybe you're putting down 25 or 30%. You're putting a significant portion down to get the interest only. So you got to balance that out a little bit. So I'm not really a big believer in the interest only because I think it is that when the interest only runs out, whether it's 1 year, 2 years, 3 years, and then you start making principal payments onto the loan itself, it's going to go that if you thought 5 or 6% as a cash on cash was good, when the interest only goes away, now you're down to 2.5%, or it starts decreasing your rates of return. So it's artificially up now. It's going to be artificially down it's really down for the rest of the term of the loan. So consider that. But who determines interest only? If somebody wants to get it, who determines it?
Sure. So on an acquisition, Fannie allows us 1 year of interest only that we can give on a delegated basis. But anything above and beyond that, it's going to require Fannie Mae's full blessing and their full review of the transaction. Again,
what delegated underwriting really means is that, so John and Fritz have the ability to make the decisions on behalf of Fannie Mae, is that if you go out with a waiver or two, and it's a significant waiver, whether it goes from 1 year up to 3 years, if you're asking for 3 years of interest only, they actually they take the file and send it over to Fannie Mae for Fannie Mae to review the entire package. So the delegated piece gets taken out. The pen that they have the ability to underwrite these loans for, improve these loans for, gets taken away, and then we put it in the hands of Fannie Mae, where Fannie Mae, they may not know you, they don't have the relationship with you, they just see the black and white on the deal, and they may not make that decision. So, and they may actually, instead of giving you interest only, they may cut down your leverage too in the deal. So be very careful when you start asking for some of these waivers, because where you think they're automatic, they're not. And they may actually hurt you if you show your package to Fannie Mae.
And to add to your point, Paul, it's like a giant jigsaw puzzle. We like to think, right, how simple real estate is. And it is, right? You have tenants, they pay rent and they have a nice place to live, and you keep it up and whatnot. But when you have a transaction, there's so many different aspects to it. So there's different aspects to the borrower's experience. There's different aspects to the market. There's different aspects to the term of the loan. Like, for instance, we said, Fannie will grant 1 year of interest only on acquisition. Well, they can delegate that, but if it's a short-term loan like 5 years or 7 years, it's harder to get that. It's not automatically delegated. So
yeah, absolutely. I mean,
so what I'm saying, and I wanted to tie back to the pre-review, because even though if a market's on pre-review, without going to Fannie Mae, we're not delegated to do a deal. Now, it doesn't mean in markets in which Fannie may not be overexposed, they may still be willing to work with the borrower on the ask. It's just going to take a closer look. And then, like we were saying before, you're going to have to just see where that transaction fits in relative to the market and the experience. And so what I'm saying, it's very complicated.
Yeah, in pre-review, it doesn't really mean you can't get a loan for the property,
No.
just like you're saying, but it has to be shown to Fannie Mae in a little bit more greater detail. And we say 65%, but usually we can get up to, if the numbers make sense in the deal, we can max them out to about 70, 75 possibly in the deal. And it's not just Doherty, it is all the 24 other DUS lenders out there. They all kind of follow the same rule book when it comes to pre-review. So if one DUS lender is telling you this in terms of pre-review, it is the same with the other 24.
That's correct. If Fannie Mae has to pick up and look at a deal, it will be on record. So if another lender shows them that same deal, then Fannie will ask that the borrower choose a particular lender
One of the
between
things
the
that-
two before proceeding to do anything.
In DUS lending through Fannie Mae, through Doherty, through all the other DUS shops, is that once you sign an application, that's the lender you've chosen. That's the horse you've chosen. You just cannot pick it up if you think that you want to bring it over now. If you've paid your fees and done your third parties, you want to bring it over to another DUS lender. Fannie Mae is not going to allow that to happen. Also, too, is that Doherty and all the other lenders are going to share that information with Fannie Mae. And so where you think you've got maybe a raw deal with one DUS lender and you're trying to get better with another DUS lender, that's not going to happen because the middleman already knows what the real story is. And so they're not going to give permission with one lender and then take that away from another lender.
No, and when you think about it, then it goes back to a relationship, and it tells you a little bit something about, if somebody's just shopping, it's good, right? I mean, this is America, and it's a free market economy, and that's what makes this country great is we can, you can shop and get the best deal. But at the same time, the DUS model was put together so that you had a level playing field among the 25 lenders, DUS lenders.
Tell me about tenants in common. I'm starting to hear that a little bit more. Why would somebody do a TIC and the benefits, and how does Fannie Mae structure those?
Sure. So yeah, we've seen a lot more, tenant in common TIC structures over the past 3 or 4 years, just with people having 1031 exchange funds. And I'm not a 1031 exchange expert, but we deal with them quite a bit. But a lot of times with the 1031 exchange rules, you have to bring in the same entity, and there could be different entities that need to come in. So Fannie requires that you have a single asset entity for each of their borrowers. But with tenant in common, you actually have multiple single asset entities. And so Fannie generally will allow no more than 5 is what we're delegated to have. And from each of the entities, you need to have a guarantor and a key principal from each one. So if you do have 5 different, TIC structures, TIC entities, we would need to underwrite one person from each of the entities.
And then have a managing member over the TIC structure itself.
Yep.
So, we're starting to see a lot more of these TIC structures because this money comes in like from an exchange, and another person has an exchange, another person has an exchange, or it doesn't have to be an exchange. It's just brand new cash that they want to, if they sell this property that they're buying in 3 or 4 years, they want to take the money and they don't want to commingle this money to do another transaction with them in the future. So it keeps in TIC wrapper all by itself. But the key thing is 5 single asset entities that go into the transaction. Let's talk a little bit about, people sometimes don't understand how we come to loan amounts and how that is all calculated. When they buy a single family home, they put down 20 or 25% of the deal. That's the way it typically works. But sometimes we have 20% down, sometimes we have 25 or 30% down. Talk a little bit about net operating income and how we come up with the loan amount.
Sure. So Fannie Mae is a stabilized lender. So they're going to take existing cash flow on the rental side. So generally Fannie will underwrite the trailing 3 months annualized for net rental income. And then they'll take a look at other income on the trailing 3, trailing 12 basis. And then they'll take a look at if it's an acquisition, like we talked about a little bit earlier, your pro forma budget, where did the appraisal come in? For real estate taxes and everything, you get to the bottom. We'll take a look at what are the replacement reserves that we'll need to escrow for. So is that $200 a unit, $300 a unit, and that's determined by the property condition report provider. And then finally, that's at the bottom of that, you take the income minus the expenses, and you get to net operating income. So you have the leverage test. You have what we talked about earlier, 80% max leverage, but also you can only have a 1.25 times debt service coverage. So you need to make sure that your net operating income, your debt service payments, you can only have 1.25 times that in net operating income. So when in today's environment with low cap rates and as interest rates have ticked up a little bit, it's becoming a lot harder to get max dollars because of that 1.25 test.
Yeah, sellers still want maximum sales proceeds on the deal, so they're not changing that. Interest rates go up a little bit, kind of like a teeter-totter. Interest rates go up, loan dollars go down. So we still have to keep that 125. We have to make sure the property is making enough money to cover its mortgage payment. And if it's not making enough money, then we're going to cut our loan dollars down to make sure it does make and meet the 125 debt coverage ratio. Anything to add to that, John?
No. The analogy, correlating the multifamily analogy with single family is a good way to look at it because, single family lenders figure out loan proceeds the same way. It's how much income the family or the mortgagors can afford to buy in the house. So right. You're doing that with a multifamily property. It's just that getting to that number is a little more complicated because you're using investment piece of real estate.
Absolutely.
And then there's just more components that go into it.
The other thing I'll add is, with interest only, that's fully amortizing debt service payments. So say you have 3 or 4 years of interest only, even though in those first 3 or 4 years, your debt service payment's going to be a lot lower, we're going to run the calculation on as if you were making the full interest in principal payments.
Absolutely. So talk a little bit about prepayment penalties on Fannie Mae loans. What type of prepayment penalties are there? What do people have to know about prepayment penalties?
Sure. So generally, they all have call protection. So generally with Fannie Mae, you see yield maintenance or step-down prepays. In some instances, step-down prepay is generally a little bit more expensive, somewhere in the 20 to 30 basis point higher, just because it's a little bit easier to pay off. Yield maintenance is generally, so on a normal 10-year term, there's 9.5 years of yield maintenance. And then after the 9.5 years, the next 90 days is 1% prepayment. And then the last 90 days are open with no prepayment at all.
And what is yield maintenance? Tell me a little bit about that in comparison to a step-down prepayment penalty.
So yield maintenance is a little bit of a complicated calculation, but essentially it's call protection for the investor that purchases the mortgage-backed security. So say your interest rate is 5%, and over the next 2 years, interest rates drop by 2%, and that bond investor who purchased the security can get a 3% note rate, and so you want to refinance the transaction. Well, you made a commitment to the bond investor when you rate locked and closed the transaction that for 10 years that this was going to be your interest rate. So generally, what they would do is take the difference between the U.S. Treasury for the remaining time of yield maintenance and the delta between wherever your interest rate is, and you have to pay the net present value of that difference. So say in year 3 you want to prepay your mortgage. Well, you're going to have 7.5 years of yield maintenance, and if rates have dropped, that delta could be pretty large. You're going to see a pretty sizable prepayment. Now, on the flip side, if rates go up, the bond investor is going to say, well, yeah, you can pay me off, and I'll just go get a higher rate somewhere else.
Right.
And so it's a little more lenient.
So having a step-down prepayment penalty is a percentage of the transaction. It is a predetermined amount, what you would pay as a prepayment penalty in year 5 or year 6 or year 7 or year 2. You already know that. Mm-hmm. The yield maintenance, you're not specifically assured about what the cost is to get out of the loan. That's why with Fannie Mae loans, which is different from bank loans, is these loans are assumable. Mm-hmm. And so that's what typically people do, is that during the term of the loan, whether it's a 12-year term, if you want to sell that property, you go in and leverage up the deal. So you have somebody assume the first lien, and if there's enough NOI that it does make sense, you may be able to get a supplemental. So let's talk a little bit about the supplemental itself and what are some of the rules on the supplemental.
So on the supplemental loans, if it's an acquisition, so an assumption in supplemental, Fannie Mae will go up to 75% of the current value between the two. And they are separate, mortgage, your first lien and second lien. So obviously the first lien stays the same. The second lien is priced at today's rates. So they're generally a little bit more expensive than normal first lien pricing, just based on the inherent risk of a second lien.
Yeah, they're coterminous, which means the loan has to be paid off. They have the maturity of the same lien. The first lien is the same maturity as the second lien against the property itself. A little higher interest rate because when you've taken out that supplemental loan, you may have taken it out on year 2, and there's maybe only 8 years remaining on the first lien mortgage. So the bondholder is trying to find an 8.2 maturity in there. These loans are not typically large loans. They could be from $1 million up to $3 or $4 or $5 million. Interest rates can be a little bit higher on that. So just know that you can, if the numbers make sense, you can get a supplemental loan. You could assume the first lien, or if you're buying the property, if you looking to take cash out, because the supplemental is to pay back to some of your investors, repatriate the cash back on the deal too.
And just to add, for a supplemental loan, you typically need, the requirement is usually for a year to elapse between the closing date of the original loan and then the date the supplemental loan closes.
Okay. So this is a jump ball. Foreign buyers, will Fannie Mae do a loan to a foreign investor in the United States?
Depends on where they're from. There's certain countries that they're a little more lenient on. I know Canadians, they're a little more lenient on. Mexican citizens, they're more lenient on. We've worked with Israeli citizens before, but generally they're going to want one of the parties, one partner that is U.S. citizen and has the majority of their cash here.
No problem having a green card on some of these deals, or is there any issues with green cards?
So for Fannie Mae, if the borrower has to be a U.S. entity, and then if you have a key principal that's foreign, there's generally going to have to be a layer or another layer between the KP and the borrower that's U.S. based.
What are bad boy?
That's established. Yeah. So it can't just have been established overnight. It's going to be somebody that has been around doing this kind of business for several years.
Sounds good. What are bad boy clauses with Fannie Mae, and what does that mean to sponsors?
Bad boy clauses are, we call them carve-outs, and basically the big ones are fraud, willful misconduct, and environmental contamination. So what that means is when a loan is non-recourse, it means the lender's only recourse is to the real estate asset itself and not to the guarantor's property or any other assets that the guarantor holds or owns.
Yeah. So if you violate these covenants, these clauses, these slap on the wrist, that could be, you can go from having a non-recourse loan to having a recourse loan. So be very careful with the transaction. We don't want to have a purposeful omission of any problems. We don't want to see an insurance claim that gets pocketed into your money. Your partner, your largest partner, is the lender, is Fannie Mae in these transactions. They're going to be the ones that are going to push out the repair piece. They're going to write the checks out for that. You're going to be the ones responsible for getting the work done to the property, but they're going to be the ones that are going to be putting the draws out and making sure that all that stuff gets paid. It's the protection of the collateral. They're there for the protection of the collateral. The property starts to fail. You want to file for bankruptcy for some reason. You stand in the way of Fannie Mae coming in to try to get the property back. You violated a bad boy clause. So know what the bad boy clauses are so it doesn't go from non-recourse to recourse. So, I mean, that's one of the things. Finishing up on the podcast here a little bit, I want to talk a little bit about, you mentioned it before, student housing, military exposure, senior housing, manufacturer housing. Talk a little bit about student housing. What should we look for in student housing, Fritz?
Yeah, so Fannie, the first thing I would say is Fannie will really only lend on student housing where universities have more than 10,000 students. That's a big one for Fannie. They really don't bend on that at all. So make sure they have more than 10,000 students. They have little different coverage requirements for student housing. So it's 1.3 times coverage instead of 1.25 for a market rate asset. With students, there can be students at an apartment complex, but it has to be less than 40% of the students. And Fannie's definition of a student is someone that needs a parental guarantee, essentially, to qualify and get an apartment unit. If it's a grad student and they have a side job or a full job that can cover and they meet the requirements to qualify on their own, Fannie does not deem them as a student.
Right. And how about military exposure? I mean, a lot of military bases throughout the country. You have a property that's next to a military base. What are some of the rules with that real quick?
It's similar to student housing. You can have military members, but less than 40% for it not to be deemed a military property. And if it does, say max LTV at 75% on an acquisition and 1.3 times coverage.
John had already talked a little bit about senior housing, manufactured homes, large mobile home parks or so. Tell us a little bit about that.
Yeah, so Fannie and Freddie are the largest lender in that space. The normal requirements are similar to just typical market rate housing. There's some obviously specific items within the nature of that business. They generally want a property rating of a 3, 4, or 5 for them to move forward with those, but they're just as aggressive on those properties as they are on apartment buildings.
Yeah, again, they don't want to own the mobile home house.
Yes.
They want you just to have the space rent that comes in, and they want a higher quality park typically that has curbs and making sure that it's been blacktopped or it's there's other amenities to the property, whether it's a pool or a clubhouse. But they're one of the largest lenders for permanent lending in the manufactured housing piece. I brought JC into the podcast to discuss some of the benefits of early rate lock with Fannie Mae. JC, can you kind of go through your transaction you're in the middle of and some of the things that you've learned doing some early rate lock?
Yeah, Paulie. I mean, I think, one of the great things about working with, and we've been partners with Doherty for many years, is we've really developed a great relationship with them. And we're big believers in the Fannie product because we're long-term investors. And a lot of the benefits of what we get with a Fannie Mae loan is right up our alley. So, stabilized value-add properties is what we do all day. And so, but one of the challenges that we face as deal doers or sponsors or guys putting together these big projects is when we're looking to get into contract on a deal, we basically have a quote from a lender, a Fannie Mae lender like Doherty, that tells us, hey, you're going to have this particular interest rate. Once you guys sort of are able to, let's say, fix the rate, let's say 30 or 45 days later after contract. Well, that represents a big risk because we're out there putting our deals together based on what we would call a pro forma interest rate. And, if you've got, a huge loan, a swing of, 25 basis points can be a big deal in terms of what we thought we were going to have as our return structure and what we would have if the rate swings wildly. So from our perspective, mitigating that risk is one of the things that we really thought about. And to sort of back up, right, historically, we were doing a huge deal right when the 2016 election was happening. If you got anybody that was doing loans back in those days, I think they could vividly recall what exactly they were going through. It was not happy times. We saw a rate swing by maybe 0.5% within a span of maybe a week or two. And we just happened to be actually trying to lock a rate during that time. So we got hit hard. We had more than 0.5% swing in our rate, which meant not only did our investor returns go down, but also our loan proceeds got cut because our DSCR was out of whack at that point. So, we lost, nearly $1 million on the loan proceeds. We took a big haircut on the investor returns. Long story short, we still closed the deal, but it was really an experience for us that was not a happy thing. And many people went through it. So, you fast forward to sort of how you correct from these sorts of issues as an investor, as a smart person that's doing these loans. You got to figure out, look, is there a way that we can sort of still get the best of all the worlds of a Fannie Mae loan, but yet try to rate lock ahead of time so we take that risk off the table for our investors and so that our deal profile is exactly what we thought it was going to be when we underwrite it on the front end versus when we close the deal. And so this streamlined rate lock for us is a great way to sort of take that risk off the table. Now, there's other downsides to it, but for us, the upside of that is we get to fix our rate ahead of time. So maybe we can talk a little bit about with Fritz and John about how that streamlined rate lock works. And I can kind of weave into the story of how our deal kind of worked out to our favor with that strategy, right?
Yeah, so Fannie came out with the streamlined rate lock program, really started pushing it a little, maybe 12, 18 months ago. And they're still, working through some of the kinks a little bit. But essentially what Fannie allows you to do is lock your interest rate, very quickly after application. And generally, Fannie's guidance on it is you should really be doing it with folks that you've been doing business for a period of time. You understand their financial situation, how they operate. Because once you rate lock, it's not like, locking your single family house. You are committed. You've put up 2% deposit of the outstanding balance. And if you don't close, you lose that 2%. But in terms of what you need to streamline rate lock, Fannie's guidance, they kind of direct it back to the lender to see what, they're comfortable with. Generally, we like to see, at least some third-party reports, make sure the appraisal checks out, make sure the PCA checks out, property condition report checks out, and the phase one, there's no phase one issues. You've taken a look at it, survey and title. So once you lock, you're committed, but it allows you to, just like JC said, I was doing it in the loan lending business in 2016 during the election, and it was not a fun time. And I think when you've gone through that, like JC mentioned, it kind of stays with you. But the Streamline Rate Lock program, it's been a very competitive program.
And to add what Fritz and JC had talked about, not only do we want to be doing business with repeat clients and clients that we have a relationship with, but also in markets that we're familiar with. I mean, it doesn't mean we won't consider doing a Streamline Rate Lock deal in an either newer market. It's just it may take us a little more time to get comfortable with doing that.
So as we wind up the podcast right now, it's kind of an open topic. Most of the people that listen to this podcast either are trying to do their first transaction or they've done their second or third one. And they're trying to accumulate as much information as possible. Any helpful hints about Fannie Mae that we may have missed in this podcast that you can think of? Anything that would help benefit somebody that wants to get into a Fannie Mae loan?
One thing working on a lot of these transactions, a lot of these with Paul and his team, is make sure you get your lender involved and your mortgage broker involved early on in the process. Don't go under contract and then, waiting to pick a horse in the letting side, and then all of a sudden you've done your due diligence, but you got to close in, 30 or 40 days. Make sure that your mortgage broker and your lender is involved, from the beginning, so everyone's on the same page for a closing timeline.
Yeah, I think one tip that I would give to all your listeners out there is that not every DUS lender is the same. I've had a lot of experience. We've probably done Fannie Mae loans or had loans with Fannie Mae with maybe 4 or 5 different lenders. And I can tell you for sure, without a doubt, that Doherty probably has some of the sharpest people and some of the best operational systems on the back end to kind of help things have a smooth transaction, both from start of contract to closing and getting the loan funded, but also on the back end. For example, when you're processing these big draws and you're doing all these things that require you to interact with their back end folks once they're on the servicing side. Believe me when I tell you, listeners, that having the right type of a Fannie Mae lender on that side is going to save you so much headache and hassle, and ultimately it's going to give you more bandwidth to focus on what's really important, which is making that deal work. So, remember that it's not just about the interest rate. It's not just about the terms that the lender's going to give you. It's about the overall package and how that lender is going to treat you as a business partner in the long term. That's how you're going to be successful, right? My thing is always go long, not short, baby. That's how you're going to win this business.
Guys, anything more to add to our discussion here? Well, I want to wish you guys a happy new year. Thanks for being on the Old Capital podcast. Again, Fritz, thanks. John, thanks. We appreciate that. And always a pleasure. JC Castillo.
Thanks for having me.
We'll see you January the 16th up in San Mateo.
San Mateo, yes. Facebook, Apartment Investor Network. Search us out and you can find us there. Thanks.
Or go to the oldcapitalpodcast.com for more information about the January 16th event and the February event in Dallas. Again, thanks everybody. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.